Good morning, everybody. Happy Monday. We have an amazing show for everybody today. What do we have, Krystal?
Indeed we do. Boy, oh boy, do we have a show for you this Bank Bailout Monday. We're going to go deep on what exactly is going on in our financial system, the government's reaction. President Biden is expected to speak today. There is a lot to talk about there, so we are going to cover that extensively. A couple other stories we want to make sure to touch on this show, too. Norfolk Southern, an effort by a couple of senators, bipartisan fashion, to try to hold them to account, and also some notable comments from former Vice President Mike Pence, finally kind of saying what he really thinks, I guess, about Trump and in the most cringe possible setting. So we'll break all of that down for you. But before we get to any of that, big news we announced last week, we're really excited about our video, full show in video, now available on Spotify for premium subs.
That's right. So I know a lot of you have had questions, so to spare the customer service inbox, we're going to go through it here. Log into your Supercast account. Click on your Breaking Point subscription. Click on the Spotify icon to link your account. It will then open. It will ask you to log in, and voila, you are good to go. You can watch the full show within there. I know a lot of you have been really appreciating it. I know that we have a big audience there on Spotify. So now for people who are driving or whatever, I'm not saying that you should do this while you're driving, but maybe at a red light if you're interested in what we're throwing up there on the screen. This is a specific example. Somebody told me about how much they loved it. So
really?
There you go.
Nice.
We've got the video there. I think you guys will enjoy it. You can speed it up, listen to us at 3.5 or however you want it to be, and you can switch seamlessly back and forth as up to the Spotify platform. It took a lot of work for our team and for Supercast, so thank you guys so much, and thank you for everybody who has signed up to support the show. And of course,
if you are not a premium subscriber yet, you can go to breakingpoints.com in order to become a premium subscriber and then follow these steps that Saagar just laid out. And to be honest with you, I mean, we were really excited about getting the video on Spotify, but I'm not sure that I knew how much you guys would be excited about it. So thank you for the tremendous feedback. It looks really great, so super psyched to be able to offer that to you, all of you.
That's right. And for all the new improvements coming to the show, it's going to even look even better on the Spotify screen.
Indeed.
Okay. All right. Let's start with the totally not a bailout. Let's put this up there on the screen. I did that breaking news segment for you guys on Friday just to get everybody up to speed when the FDIC and California regulators took over Silicon Valley Bank. Lots of speculation all over the weekend. Massive calls and pressure on the financial system to pursue a bailout of depositors. And lo and behold, Sunday evening, Secretary Yellen, the chairman of the Federal Reserve and the head of the FDIC, come out with this statement. Secretary Yellen has approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all of their money starting on Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. So let's take a step back and just remember. So Silicon Valley Bank goes into federal ownership on Friday. They start to administer the bank. They begin to pursue a variety of options. One of them is a forced sale where another company is going to come in and buy Silicon Valley Bank, then fulfill the depositors. Apparently, there were some indications that PNC was attempting to buy the bank, but they decided to pull out at the last minute. So then what ends up happening is that the FDIC, despite the fact that they only insure deposits up to $250,000, invoked something called the systemic risk exception. The systemic risk exception allows the FDIC to protect the deposits of all depositors, even over that of $250,000, of which some at least 90% or so of the deposits in Silicon Valley Bank were. This was the bank, as I had mentioned in that segment, that processes at least up to 50% of the bank accounts for almost all tech startups in the United States. A tremendous amount of tech wealth was concentrated. My personal favorite example is that Roku, a multi-billion-dollar company, had a single checking account with $457 million in the account.
Which, let me just say, pause on that one, that is absolutely moronic.
Oh, it's nuts.
That is, I mean, that CEO should be fired instantaneously because it doesn't take a financial guru to know that you are only insured up to $250,000. So they placed a $500 million bet effectively on the idea that the government would come in and bail them out, which, hey, ultimately worked out for them.
Well, here's what's the crazy part of it, which is now basically we've set a standard for, we'll also talk about the other bank that's been put into ownership of federal regulators and is going through later on. That has more to do with crypto. It's an interesting example, but the systemic risk option was invoked for that bank as well.
Is insane.
Oh, yeah, it's also crazy. And I look, I'm not saying I don't feel for people who have their deposits in the bank, especially if you got tech startup and you got to make payroll. And I know that it's very, very dicey and it's very stressful. So I have total sympathy with those folks. But we got to take a step above and look at the total financial system. Per David Sirota, we have $9 trillion in deposits in banks across the United States that are over the threshold, that are completely uninsured. We have now set the precedent that if a bank fails, your deposits are totally good to go. Okay, I mean, I'm kind of actually okay with that, but, and this is the big but, then the banks, though, are getting to use our money, our deposits, to take loans and to make a lot of profits. But then when they fail, the deposits are backed by the feds.
Right.
So how does that work? So you either have a private bank with the attendant risk of having a private bank, or you have a public bank. I'm not even necessarily saying I support a public bank, but maybe the option or something like that. I don't want federal control of all money. But the entire point of having a private banking system was the idea that there is some attendant risk with the FDIC that's going to insure you up to $250,000. So this has really blown the cap off of the idea that this is a private industry really in any way. And I don't know why these people are allowed to make millions and millions of dollars if their deposits, which is the fundamental part of all of their wealth and their balance sheet, is going to be totally insured by the federal government.
That's right.
Yeah.
And I think that's an incredibly key point. Whatever you think about this bailout, and don't let anyone gaslight you into thinking that this is not a bailout, and not just of SVB and not just of First Republic, which is the other bank that failed, but of the entire banking system. So 2 things you need to recognize. Number one, as Saagar was just laying out, this de facto indicates to every bank in the entire country that even though they've only been paying into the FDIC to insure $250,000 deposits, de facto, they actually have insurance on 100% of deposits. Now, the powers that be here, our central bankers, are saying, oh, no taxpayer dollars are on the line. Okay, maybe not technically for Silicon Valley Bank, but who do you think is backstopping that entire insurance system when the banks have not been paying in sufficient funds to actually insure the entirety of the deposits? Who do you think is on the hook for that? That's number one. Number two, in some ways, the least important thing they did was to backstop these particular deposits, because in addition to that, they also announced new lending availability for banks across the country. And not only that, but the reason that Silicon Valley Bank failed, one of the reasons, is because they held a lot of their assets in long-term treasury bonds. As the Fed has lifted interest rates, that has caused the value of those bonds to decline. So they were suffering losses in terms of their assets. And we're going to show you in a moment how they were sort of an outlier in terms
outlier.
In terms of this particular, use of their assets. And also they're consolidated in one particular industry, which also was very sensitive to Fed interest rates. That's the reason that this bank ultimately collapsed. Okay, so they had to take losses on those assets. The Fed is now saying that if you hold similar assets that have declined in value, they're not going to force you to take losses. They're going to pretend that those assets are still valued at what you purchased them for. That is effectively a gigantic giveaway, not just to SVB, but to the entire banking system. And again, the idea that, oh, this is just taxpayers have nothing to do with this, all of this is based on the fact that this is backed by the U.S. government, which is backed by the U.S. taxpayer. So you have 2 things that have happened here that are incredibly significant in ways that I struggle to completely wrap my head around. Number one is, as we said, the 100% of deposits now apparently insured by you and me and the federal government. Okay, that's number one. Number two, this idea that these 2 banks, which just failed, are quote unquote systemically important, this is insane. It's ludicrous, especially this crypto bank that just failed. This is not a large bank.
Well, that's what really sets the precedent of any bank that fails is now bailed out.
So the precedent that is set here is every bank is too big to fail. So, okay, if that's where we are, we need to have an entire rethink of our banking system, to your point, Saagar, that reflects the fact that ultimately the U.S. taxpayer is on the hook for all of these banks and for all of these deposits. And, there's a lot of talk about, okay, is it a bailout or not? And these depositors, they didn't do anything wrong. They deserve to be bailed out. Okay, that's fine. We have definitely bailed out the executives and shareholders of every other bank in the country, especially ones that had similar risk profiles as what this bank ultimately did.
So let's go into this even deeper. Let's go put this up there on the screen. Our friend Jeff Stein asked this to a Treasury official. He says, aren't you exposing the U.S. taxpayers not just to uninsured deposits that need to be guaranteed, but for trillions more throughout the banks in the country? Quote, I think we will right now focus on addressing the current issue and stabilizing the banking system, assuring uninsured depositors that they will be made whole. But I do think we'll be looking back and reassess and assess whether any changes should be made. I want to emphasize again, this is funded by fees on banks. But here's the problem with that. There's only $126 billion in the FDIC account to quote unquote bail out the depositors of all of this. That's barely enough to cover the uninsured deposits in Silicon Valley Bank. To take it even further, Krystal, and why it's a de facto tax on all of us, if the banks have to start paying more into the FDIC, right now they're at $126 billion, they have to get up to $9 trillion to eventually insure all of this. You ever heard of a bank that's going to voluntarily pay more money? Who do you think is going to be paying those fees?
Yeah.
It's customers. We're the ones who's, already bank accounts, they'll charge you for it if you have a low enough deposit. Guarantee you, if they have to increase the amount they're paying to the FDIC, every single one of us are the ones who are going to be paying for it through all these BS banking fees, increase on annual fees on your credit. Oh, they're going to charge you for a debit card now. Oh, you want some checks? That'll be like $900, some other outrageous stuff. They will never pay it voluntarily.
Yes.
There's no possible way that you could ever enforce that.
Silicon Valley Bank, and this is more reporting from Lever News, who, by the way, has done some of the best reporting on all of this, and especially as they do following the money in terms of corruption in politics. Silicon Valley Bank was lobbying against increasing the fees that banks have to pay into the FDIC, saying, oh, there's no risk here.
Good.
There's no problem. Very low risk, so don't need to worry about it. We saw how that ultimately worked out. There's one other thing that I really want to bring up here, because I think there is a notion out there that if the federal government didn't step in, that these depositors at Silicon Valley Bank would have lost everything. It would have been wiped out, everything above $250,000. But there is, in fact, a process in place that is supposed to be followed in such a situation, which is, okay, first $250,000 insured, no problem, everybody's clear on that. And then the rest of the deposits are backstopped by the assets of the bank.
Right.
So the federal government sells off the assets and then makes depositors as whole as possible. Based on what we know publicly available, that would have caused probably like a 10% haircut. You still would have likely had people getting somewhere around 90% of their deposits. Now, the argument that was made in quite strident terms over the weekend, in particular by a lot of people in Silicon Valley who have skin in the game, is that you can't just let depositors take a haircut. You can't let the normal process play out because there's going to be a bank run. It's going to be a catastrophe across the system. And so we have to act now to make sure they get 100% of their money right away on Monday to forestall that possibility. I think that's possible. But I also think that regulators were really swayed by the fact that you had a lot of influential people very loudly proclaiming in certain terms that there was going to be a bank run, and that scared them away from allowing the normal process to play out and forced them to levy this, absurdity that these were both systemically important banks and, again, effectively codify within our country that literally every single bank is now considered systemically important, i.e. too big to fail.
So let's put the third one up there on the screen. This is an important piece by Matt Levine, how the startup bank had a startup bank run. One of the problems for Silicon Valley Bank is its customers had too much cash and now they simply don't. What he's referring to is that startups that were cash flush kept their bank accounts very high in their balances throughout 2021. Then throughout 2022, as federal rates began to rise and they had to begin pulling cash out to cover a lot of expenses because they were unable to raise even more money, they began to withdraw. Now, as the withdrawals continue, as I said, Silicon Valley Bank, or as you laid out, Silicon Valley Bank had a lot of treasuries, so they had to sell many of those treasuries at a loss in order to cover many of the deposits that were getting done. All of this cascades to the point where it's a very shaky procedure. Then they have announce a new equity raise in order to try and pump cash into the bank. That is what really triggered a lot of people to say, oh, clearly there's some bad stuff going on here. And then on top of that, you had kind of group chats and other very influential people in Silicon Valley getting a hold of this, understanding that this was going to happen. And within, I think, about a 24-hour period, almost $42 billion were withdrawn from the bank. That enough was just able to completely collapse it because they didn't have the attendant cash that was available to them. Let's go ahead and put the next one up there. Our friend Kevin Roos actually did a pretty good write-up here in the New York Times. And really what he talks about is that this is the first online bank run, in that the rumors around the insolvency of Silicon Valley Bank spread so quickly. It's part of the reason why you had that $42 billion within a single day that was withdrawn, and why the feds had to step in so quickly and not even be able to broker some sort of deal. So this was a bank just so deeply entrenched in Silicon Valley, it's almost difficult to comprehend. I mean, they had all sorts of complex financial instruments that don't make sense for any other bank except for one that focuses on tech. And that's great in the boom times. It's bad in the bad times. And what have we learned right now? We just actually had hot jobs numbers, but tech is disproportionately having a lot of problems, especially with the demise of cheap money. And I think that the concentration of so many cozy banking relationships, the Roku being a good example, having some checking account with $450 million. He may not even have the most amount in his checking. There might be people in there with like $1 billion balance, which is nuts. I mean, anybody who has anything to do with this business would tell you that that's outrageous.
Idiotic.
Part of the reason why, though, is that Silicon Valley Bank had such a long relationship with many of these people that they felt a deep amount of loyalty, and in some cases were signing them into exclusive lockups, where if they got venture debt through Silicon Valley Bank, they had to keep their checking account there, they had to do their mortgage there. It's basically like a vertically integrated tech bank, which again, it disproportionately exposes it. And whenever you look at their balance sheet, let's go to A4 here, please. This is a really interesting one that was actually put together by some financial analysts. You can just see clearly the higher risk deposit base, those who are just watching, the U.S. bank to loan, the U.S. bank loan to deposit ratio, those who are looking in the top right, look at every single other bank, and then look at Silicon Valley Bank well over the 100% mark, right in the higher risk deposit base zone for nearly 110% of their loan to deposit ratio. So already they had a very high loan to deposit ratio. And then at the same time, whenever you look at Silicon Valley Bank, they had a very high impact of unrealized security losses on their capital ratios because so much of their assets were held in private markets where you had just a decimation of value. So there's a lot going on here.
Yeah.
A lot that just shows you that, as you said already, we showed you they have a high loan to deposit ratio. Their treasuries, I think in terms of their assets, they had 17% more in treasuries than any other bank in the United States. So already you just have bad executives that are at the top. Actually, some people who work at Silicon Valley Bank spoke to some people around them, and many of them were outraged at leadership who really didn't tell them what was going on. They announced that raise, which effectively collapsed it. They had no idea, and now they're possibly out of a job. So there are people at the bank itself who are really upset. Senior management, the FDIC says they're gone. But look, really the question is like, are these people going to make money? Because they say the taxpayers will bear none of the losses. I don't want to see a single one of these people who is getting the bonuses that AIG got in the middle of their bailout. And there's no guarantee on that right now. Zero.
Well, and we'll show you the numbers on this, but a bunch of management were cashing out and selling their stock in recent weeks. Oh, and by the way, they announced bonuses literally on the day that the government took over the bank as well for their employees and executives. So, they're going to be okay, I think, is the bottom line here, even though they're the party line from the government is that they were, quote unquote, wiped out. Mm-hmm. And again, really important to keep in mind, we're not just talking about backstopping the depositors of these two banks here. That's one thing. We're also talking about a whole new Federal Reserve lending facility using basically souped up and fake asset prices as collateral, allowing this. So this is a massive injection into the economy that has huge ramifications. And also, by the way, sort of stands directly at odds with the direction of monetary policy tightening that the Fed has been engaged in. And that's a whole other piece that we could get into. But, the expectation was that the Fed was going to hike rates another 0.5%. So that's a very significant raise. Well, now you're going in the opposite direction, injecting funds into the economy and, rescuing these particular workers who are involved with these particular bank, while your overall policy has been crushing workers and trying to trigger a recession in terms of the labor market. So they also had their hand forced and are now directly at odds with themselves in terms of the direction of policy. There's one other, there's a lot more we could say about this, but I also think it's really important to point to the fact that, this is a striking example of how the tech economy is in a wildly different place than a lot of the rest of the economy and the job market. That's number one. And number two, it's always incredible when there's a crisis that impacts wealthy and influential people. Somehow they always have the mechanisms in place
like instant
to quickly act. They don't have to wait and beg the parliamentarian or kiss Joe Manchin's toes or whatever. They don't have to do anything. They just they figure it out. They figure out the facilities. They make up bullshit rationalizations like, oh, they were systemically important. Okay, whatever. And somehow they're able to come through with all the cash in the world that they possibly need to backstop the system when it's wealthy and influential people whose lives and money are at stake. I think it's important to note that effectively, I saw a tweet this morning. It's like democracy at this point basically means rule by judges and central bankers. Yeah. And I think that's really, it's really quite apparent. So we've set up a system that reacts incredibly quickly and incredibly effectively when it is the wealthy whose interests are at stake. For everybody else, you got to haggle, you got to go through Congress, and ultimately nothing ever happens.
Right.
Hey guys, ready or not, 2024 is fully upon us now, and Saagar and I have been brainstorming ways that we can really up our game for this critical election.
Yeah, we rely on our premium subs to expand our coverage, to add staff, to upgrade the studio. We just want to give you the best independent coverage of this election, which is possible. So if you can help us out, become a premium subscriber today, breakingpoints.com, or the link is down here in the description video. It really means the world to us, and if you like what we're all about, this is the best possible way to keep us 100% independent, working only for you.